Do you want to learn how to get retired, stay retired, and enjoy your life to the fullest? This is the Retire Happy Podcast with certified financial planner professional Jeremy Finger. Jeremy will be your guide to happiness as he discusses the art and science of retirement, breaking down the complicated information to help you make good financial decisions without worry or burden. Now, on to the show.
Hello and welcome to Retire Happy with Jeremy Finger. Jeremy, what's going on?
Oh, just living life and trying to help people. That's all.
Yeah, well, I know that you brought somebody in to help you help people, right? You got a guest on the show today. I'm loving this.
We do. We have a very special guest, a guy I know, John Nichol. He is Senior Vice President and Senior Portfolio Manager at Fundamentum Investments. He has over 30 years of portfolio management experience, and he's a chartered financial analyst. And hey, he's going to share with us a little bit about what's going on in this crazy investment environment we got going on right now.
Well, I'm telling you, I'm excited about this. We're recording this after a hurricane has come in and hit the coast. And I think that people feel like there's a hurricane happening right now with the market as well. So I'm all ears.
Yeah. Well, we got the right person here to share with us some insight. Welcome, John.
Welcome. Thank you.
Yeah,
it's exciting times here right now, both out in the streets and in the markets.
That's absolute. Yeah, I can't agree with you more. So probably for most of the listeners out there right now, with interest rates rising and markets going down, what are your thoughts on the environment we're in right now?
Well, we're in a tough environment where, for let's say the last 10 to 15 years, we've had falling rates. And the Fed has been very supportive of the markets and the bond markets over the last 10 to 15 years because of supply disruptions because of COVID, because of the Ukraine war. Inflation sort of got let out of the bottle. And what that has caused is the Fed to act a little more aggressive and raise interest rates, which we're all aware of now. And so you've had a double whammy of inflation, higher interest rates, which now is causing the economy to slow down. So that's what the real issues are, that you had the first half of the year, the markets were down mostly because the scarcity of going from 0% interest rates to some level of interest rates. Basically, there's no more free money. Now we have the opportunity. We have the issue of, oh my gosh, the Fed's raised rates and it's going to hurt housing. It's going to hurt the autos. It's going to hurt this, and the economy is going to slow. So that's the problem, or the box that we're in right at this moment. Okay.
So, all right. Well, what can we expect going forward? Is there a supply going to open back up? I mean, what's the Fed really looking for to be able to see that there's light at the end of the tunnel?
Well, unfortunately, I think it's just going to take some time. The Fed is starting to see stuff like commodities, oil prices, gasoline prices have rolled over, lumber prices have rolled over. So on the commodity side, things are much better, but in rents and in the job area, that's still very strong. And the Fed just wants to sort of put they used to tapping on the brakes, but what they're doing right now is they're full-fledged slamming on the brakes, and we don't know when they're going to let up. I would say we're probably closer to the end of the cycle than the beginning of the cycle, so that's good news, because historically, when the Fed's done raising rates, the markets tend to go up for 2 to 3 years, multi-digit. So that's a positive rainbow at the end of the problem that we're at right now.
Okay. All right. Understood. Yeah. And so you don't have the crystal ball to know exactly when that might be.
Well, I would say two things are going on that people need to look at. Seasonals right now are horrific. And what I mean by that is you can go back and look at the monthly performance of the S&P, of the Dow Jones over the last 10, 30, 50 years. And September and October historically are the worst performing months. So that's not a good atmosphere to start from. On top of that, we have earnings coming up in October. So it's third quarter earnings where corporations, the IBMs, the Walmarts of the world, get to report their earnings. And so far this year, earnings have been fairly positive, which is sort of ironic because you hear that we're in this recession with the GDP being down 2 consecutive quarters in a row. But earnings are still positive. So that's the key question is, do earnings hold up or not. If earnings hold up, we're probably very close to the bottom, if not at the bottom. But if we do go into some type of profit recession, because the Fed keeps on raising rates, and everyone historically in a recession, earnings fall 10 to 15%. So that's sort of the downside in earnings and the downside in the market that we have right now.
Okay. Well, I know this may sound weird, but does the Fed want there to be earnings problems with the stocks? I mean, like if commodity prices are going down and earnings are lower, would that mean therefore, hey, maybe we've done enough with interest rates? Is that what are they really looking for?
The question everyone's asking is, when is the Fed going to pivot, or when are they going to stop raising rates, or maybe even potentially cut rates? And that's what we had the strong rally in the summer, because the markets were definitely oversold by June, and people thought the Fed was going to pivot, and then earnings came out and they were fairly decent. So the market rallied on that. But then the Fed came back in September, August, and basically laid the boom down on the market and said, no, we're not done yet. And they actually used the word pain, which most Fed chairmen in history don't say. We're waiting for pain in the market, because they didn't define it, So I can't answer that question. What I can say is I think they're looking at the jobs market right now, and we'll be getting, next week is when we get our jobs number again. If that jobs number shows some weakness, that's probably a good news for the markets that we're in some type of slowdown in rates of the Fed acting. The ironic thing is we almost want the jobs number to be bad, because then the Fed will stop raising rates. So it's not good for the individual that's losing their job right now, but for the markets in general, they want to see a slowdown in the job markets, because that's been very hot because of the COVID restrictions and the amount of growth that we've had in the past.
Okay, understood. Yeah, it's like, hey, let's show the Fed we have all this pain, therefore they will stop inflicting the pain. Is that kind of what you're saying?
That's true. I mean, another issue that you're actually seeing more pain overseas is because the Fed has raised rates and we're the haven of safety. The dollar is at 30, 40-year highs. And that's causing stress in the emerging markets. It's causing stress in the oil markets. And you just see recently in the UK that they've had to defend the sterling. So it's causing a lot of stress outside the market. Actually, Europe's on sale right now for traveling. Americans should go travel to Europe right now because the flights are cheap, the hotels are cheap, everything is cheap in Europe right now.
Yeah, 100%. I came over there from this summer, and you're right. I mean, it's like the dollar was at par with the euro, which is extremely unusual.
Right.
Yeah. And they, I talked to a few people over there, and they have a lot of inflation over there as well, with supply and things like that.
Yeah, it's funny because their inflation is actually worse than ours, because they're directly tied to the Ukrainian energy crisis, or the Russian-Ukrainian energy crisis, and their inflation is worse than ours. Yet they chose not to. They're behind the curve like the Fed was, and they didn't raise rates enough, and so the rates in the U.S. are higher than the rates in Europe, and so it's just causing it's just not a pretty sight all over the world right now.
Right. All right. So this guy named Warren Buffett. I don't know if I've heard he's a good investor.
Who's that? No, just kidding.
he said, you want to, something along the lines, I'm certainly paraphrasing. You want to buy when there's blood in the streets. So is there blood in the streets in Europe? Is there blood in the streets now? I mean, where do you see that there's opportunities abound? If not now, what do you look for when you think there is opportunity?
I think there's opportunities developing. I would say in the bond markets or in the fixed income markets, the bond aggregate is down like 13, 14, 15%. That hasn't happened since the 70s, since its existence. So there's definitely places in the bond market where you can buy a 2-year treasury note that pays like 4.5%. That's a pretty good return with no credit risk, that you can sort of batten down the hatches, get paid 4.5%, and wait and see if we go into a profit or earnings recession. Wait and see what happens to the Ukrainian, Russian war. Wait and see what happens with Taiwan and China. So on the fixed income side, I definitely think there's lots of opportunities now. On the equity side, it's a little more concerning because I do not know if we've seen the bottom in profits or like I talked about, the earnings recession. So there's pockets like in staples or utilities that hold up well in a recession. But whether you want to buy an industrial or a technology company going into a recession, that's, a semi-equipment conductor company might be something you might want to hold off. I think coming out of the bottom, there's will be a lot of opportunities. Actually, at Fundamentum, what we're doing right now is we're lining up our buy list for growth names and cyclical names to buy, but I just don't think they're on the equity. We're not there yet.
Okay. All right. Well, is there any particular indicators that you look for? I guess you mentioned a little bit about unemployment rates, if they were to tick up as far as the Fed was concerned, but is there anything that you look for that would be a signal toward that would be we're closer to the end of this thing?
I think for the end of the rate cycle, it's clearly the jobs numbers. So you can basically, look at the jobs numbers. The Fed is forecasting the unemployment rate to go up. So that answers your one question. So I guess, if they're forecasting that, that's what they're
waiting on. They're waiting
on. I don't, in the unemployment rates, we're still, we're at the lows, pre-pandemic. So on the interest rate cycle, I think you just need to look at the jobs numbers, the JOLTS, job openings, that aspects. I don't think you want to lead that buy before it. I think you can react afterward, because if the Fed does change their interest rate cycle, they tend to be long cycles. And so you'll have plenty of time to you might miss the first 1%, 2%, or 3%, but that's better than, accepting 5% down and then being right. So I think on the interest rate cycle, on the earnings front, I think we just listen to the company earnings reports, listens to the CEOs, the CFOs, the chief executive officers, what they're saying and what their product cycles are saying. Are they selling? Are they not selling their products? And industry production in the industrials. One thing we look at is we don't look at individual airlines, but we look at plane travel overall. We look at cargo hauls in the railroads. That tells you, is there economic activity or not? And those still are holding up right now.
Okay, understood. So let's say I'm a pre-retiree, I'm about to get retired, or I'm already retired. What are some of the things that if I'm kind of living off my income for retirement, what are some of the things that you would want us to think about during tumultuous times like this?
Well, the first thing when we talk down with advisors and clients, we talk about, their financial objectives and then their risk tolerances. That's probably the most important thing right now, because what we would not want you to do is sell out at the bottom of the markets, because then you never usually get back in, and that could be a generational hit to that family. And so what we try to do is we talk about risk tolerance, financial objectives, and we try to provide a portfolio of diversification. So yes, something might be going down. High growth stocks might be going down, but energy stocks might be going up. High yield might be going up and treasuries might be going down. So there's always something that the yin and the yang of the market. It's been a little more difficult this last 6 months because bonds and stocks both went down. But if I look into my crystal ball, although sometimes it works and sometimes it's cloudy, but when I look at it's definitely, I think fixed income is going to act more, what I would say, normal, where they act defensive, but they give you income and they give you return like that. And so I think that's going to be a positive going forward.
Yeah, fixed income. Yeah, because it's unusual for both fixed income and equities to do what it has done so far this year.
It's been high. It has not happened since the early 70s. So it's highly unusual. And you haven't seen 2 years of negative bond returns basically ever. And I think the biggest risk to the financial markets right now are, do we go into a recession? And if that happens, that's not good for stocks, but it's actually very good news for bonds, because bonds tend to react well in that environment, because they're basically the balance sheet, and they provide a yield or an income.
Okay. So what I kind of hear you saying, as far as fixed income is concerned, we may have experienced the brunt of most of the pain thus far.
Absolutely.
Okay. So if we come out of this thing, great. Bonds still should do well, should, right? And if we end up going in recession, bonds should still do well,
Right.
and even in recession, right? So those people who are, have a fixed income portion of their portfolio, they've probably experienced most of the pain already.
I would say they probably experienced, unfortunately, 80% plus of the pain already.
That's
so
right.
I think the Fed's still going to raise rates. They've actually said they're going to try to raise rates. I think it's projected to be another 100 basis points by the end of the year.
Right.
But I don't think yields aren't going to go up that much. They might tack up 20 basis points, but that's not a performance differential that most people will see.
Right. Okay. It's not like it's going to deliver a major amount of pain.
You have to remember,
right.
we started the year basically at 0% interest rates now. The 2-year was basically at 0 and it's at 4% now. So a lot of the interest rate cycle damage is done. The question is, what damage has it done to the economy, and earnings? That's what the yin and that's how you can see the market was up 3% yesterday and down 3% today, depending on who's winning the battle.
Right. Okay. Understood. So the real variable sounds to me like that is, hey, what's the equity portion of someone's investments possibly going to do? If we go into recession, it may be a negative. If we don't go into recession, then we should be okay. And,
right.
and that's the main variable. But the fixed income side sounds like, again, we're maybe seeing the light at the end of the tunnel in that regard.
Right. We're actually looking at potentially increasing our fixed income exposure, increasing our duration, and those type of steps that benefit from a positive fixed income environment. And on the equity side, we're basically holding pat. We're not getting more defensive, but we're not getting more positive right at this moment. Now, if it's Thanksgiving time and we're sitting in, around the Thanksgiving table with the turkey, I have a feeling I will be in a much more positive environment because we'll know about the earnings recession. I think we'll know whether the interest rate cycle, the volatility in the market, basically the two biggest volatilities, the interest rate cycle and the earnings cycle, we'll know about. And we'll either know, is now the time to go 2 feet in or just put 1 foot in. So we're thinking people should actually start thinking about putting some money to work at the end of the year, but that's still up for debate right now.
Okay, understood. So, question though, is November typically a time where money managers like yourself are looking for opportunities? Because you talked about like September, October is normally tough months.
Right.
Is there a reason why that's the case, and is there a reason why maybe November might be different than?
Well, I'll give you 2 reasons why the September-October period. One is most people's companies' earnings come out in October. And there's an SEC rule that says companies aren't allowed to buy back their shares. So before they're 30 days before they issue their earnings report. So right now, there's no support in the market from the companies buying back their own shares. And it tends to be where people start looking into the next year. And so someone might say, I think I was going to grow 12% in 23. And all of a sudden, I'm actually only going to grow 8%. And so it gets reflected in that environment. But by November and December, those reset buttons have already been placed. And so everyone's looking out into the next year. They're not looking at the fourth quarter. And historically, actually the strongest periods in the market calendar-wise is actually November through May.
Oh, wow. Okay. All right, great. That's interesting. So companies can't buy back their stock when they're coming up on their earnings.
Right.
And therefore there's a little bit of downturn. So, well, I mean, I guess.
Well, the other thing is I think I really do think the interest rate cycle, we're, like I said, with the bond cycle, we're 80 to 90% there. And I've seen some studies that said after the Fed stops their interest rate cycle for the next 2 years, the markets tend to be 15 to 30% up. So you don't need to be early, but you just need to be aware that you don't want to. That's why they should be talking to a management firm or an advisor, because you don't want to be looking in the backward mirror all the time.
That's right. And also, hey, guess what? November, the turkey is in the oven right now. It's coming out in a couple months. All right. It's like, yeah. I mean, you're looking at 2 months. If someone who's looking to retire, let's say they're 58, 59 years old, 60 years old, they can be retired for 30 years.
Yeah, that's the one thing is one of the horizon, the investment horizon. People, sometimes you need to turn off CNBC because they're only looking at today or 1 day or 2 days, where you have to tell them to look over a longer time horizon. And that's where diversification and asset allocation and the type and so actually what people make mistakes about is they become overconfident or they overreact to things, and that's probably the biggest negatives of personal investing.
That's 100% the case. I deal with it. Been doing it for 25 years. I've had people around the country club say, "Yeah, this was back in 08 and 09. Oh, I sold out at 10,000 or 14,000 or 12,000 when the Dow was at 8,000."
Right.
And then I'm wondering, like 2 years later, when it's at 15, 16, 17,000, what those same people were doing.
They're probably still in cash, I have a feeling.
Well, what's funny is I remember this one person, and this was 5 years ago. He talked about, oh yeah, I bought back in and whatever, but that was the Dow was at 23,000.
Right.
So it's like, yeah, great. You get back in and you might have saved 10% on the downside, but you missed 30% of the upside.
Well, I mean, that's one of the most important things is getting everyone's risk tolerances and their financial objectives and their investments longer, so they understand that diversification, the markets tend to be up at, in 10-year period, the markets tend to be down 1 or 2 years and up 8 years. So you got to think sort of in the long term.
All right. Perfect example. I'm in Myrtle Beach. There's a hurricane that's hit Florida coast and it's coming up. All right. I'm not selling my house because a hurricane's coming. All right.
Right.
All right. So you just batten down the hatches, and I'm not going to go play golf on Saturday. So you weather the storm.
Your score might be a little high if you did.
John, truth be told, my score's been high for about a year. Okay. I don't know what I got afflicted in my swing, but it's painful. But yeah, you kind of batten down the hatches and do what you can and weather the storm. And it sounds to me like when you have good managers like yourself who can be a bit nimble, that you can look at this as some opportunity when you do become, like, let's say, I hear you saying there may be some opportunities in the fixed income environment and you're kind of holding pat on the equity side. But when you have good management, let's say when there is a time to be offensive, you can do that as well.
True. But actually, I want to say something now that's actually very opportunistic is taking tax loss harvesting. So that's sometimes that you can't do with a mutual fund, but that's something that we're actually actively doing now where shares are down 10, 20, 30%. We're selling Exxon and maybe buying Chevron. So you get to harvest the tax loss. So I guess that's the only silver lining in the markets being down 20% is hopefully sometimes a SMA type portfolio manager versus a mutual fund can give a tax benefit to the client, and that actually can be very material in these times.
Okay, yeah. So you did bring up a good point. I want to make sure the listeners are on point with what we're talking about here. SMA, separately managed account, is where a money manager like you, okay, buys and sells individual stocks. You see the stocks in your portfolio.
Right. For that specific client. So it's very customization. We talk to that client and that advisor and say, what is your risk tolerances? What is your financial objectives? And that's how we invest it. Instead of saying, oh, I want to buy a growth fund, which you can do with a mutual fund, you can do that, but this is much more specific. And then when something happens, we can act on it much more nimbly than a mutual fund can.
That's right. So you're able to do in your example, sell an Exxon, buy a Chevron or vice versa, and take the tax loss. Whereas a mutual fund, you can't do that. Matter of fact, it could be the opposite. They have to distribute capital gains by the end of the year in many instances. Okay. Yeah. So that's the difference between a mutual fund and an SMA manager.
And the other thing I want to say is one other positive is that with the SMA, you get exactly what we told you're going to get. Sometimes with mutual funds, you get this thing called style drift, that a growth manager all of a sudden becomes a value manager, or a value manager becomes a growth manager. You had a lot of value funds that underperformed this last year and a half because they looked to buy the large cap growth names to sort of support their performance. And then when they rolled over, they didn't get out of it quick enough. And so there was style drift. So that's one thing that's in my professional that people worry about is are your portfolio managers, your SMAs, your mutual funds doing what they tell you they're going to do?
Okay. Now, a question though is you talking about like you talking to directly to the advisor, possibly to the client? Do all SMA managers do that, or is there, you know?
It's very, we do here at Fundamentum. So it depends, but every SMA tends to be much more customization than a mutual fund. So in general, I don't know how much detailed it is as we go into, but there is that work with the client, work with the advisor.
Yeah. I found, at least, 25 years doing this, is that it's not often where I've seen the accessibility of someone with your expertise being available to not only the advisor, but also to the clients as well.
I can be completely blunt for that. I worked at a large mutual fund family as one of the senior portfolio managers, and I very rarely talk to individual clients. And I've actually talked to more individual clients in my last year and a half here than I have in my 19-year career where I was.
Wow. And how do you like that? Is that a positive?
I like talking to people. And actually I use that as a gauge, because sometimes you can see whether because a lot of the market right now is emotional. Because some of it's fundamental, but some of it's emotional, and you can see where people stand. It goes back to your question of when people, sell out at the bottom or buy at the top, or that kind of thing.
Right. Okay. I got you. So, are you able to have a little bit more flexibility inside of an SMA than you would be in a mutual fund?
There's lots of more. Well, first of all, we can actually listen to the individual client. For example, we have a couple clients that say, "Oh, we don't want this individual stock," and so we can restrict that and either keep it out of the portfolio, or there might be a case where let's say one of your clients worked at a small bank for the last 25 years, and he has a nice investment in that one bank stock, and he might want to keep it. So we can diversify or change his portfolio so he maintains that individual bank stock. So there's lots of things that we can do that a mutual fund basically doesn't. I hate to say this, a mutual fund doesn't really care about one single shareholder. So
hence the name mutual, right? Mutual fund. Right?
So, yes.
Yeah. Makes sense. All right. Well, thank you. What about all right, I know you get this a lot. You are a money manager, and it's kind of asking. Okay. It's asking a car dealer, "Hey, do I need a new car?" Of course you do. That's right. Tell me the pros and cons, active versus passive.
What I think with active is it's actually, you're going out and kicking the tires of the individual companies. You're a additional check. I mean, I would say being invested in the long run is a positive, but I would think having an active overlay is a positive. It prevents things from going off the rail. For example, active managers tend to always outperform in down markets, not necessarily in up markets, but in down markets. And what I mean by that is an S&P index right now is down the 20 odd percent, where most active managers aren't down that. So there's a lot of positives to active management. It actually gets a further growth story too, that you look for companies that have growth in them. For example, if you were a passive manager in the Russell 2000, which is the small cap index, that might be an interesting place to be right now, because small cap stocks the last 3 years have massively underperformed. And so maybe that's the cycle is going to turn. It's time to look at small cap stocks. My concern there is people probably aren't aware that I think it's 60 to 70% of stocks in the Russell 2000 don't earn any money. And so when you buy that index, you're buying 60 or 70% of the stocks with zero earnings. That I would probably discourage that. So that's where an active manager would probably want the small cap stocks that have positive fundamentals and good valuations. And so that's why I think where active wins over passive.
Okay. All right. That makes sense. And so, yeah, I guess there's a time and a place for active, and possibly a time and a place for passive.
I mean, I think having both is actually a relatively good strategy. You might want your baseline to be passive, but the above portion you probably want a little more control over.
Okay. And you mentioned about, I guess fixed income maybe it'd be an opportunity. Do you see where you mentioned a little bit about defensive being, I think you said healthcare and maybe utilities going into downturns. Is there anything else out there that you see that might be more defensive, or when we do come out of this thing, what might be more opportunistic, what areas that generally might be more opportunistic?
Well, I think the one defensive area where people could consider is there's a new asset category. It's not new. It's been known in our profession as the alternative area. And so you used to have cash, you used to have fixed income, and you used to have equities. Now there's an area called alternatives, which tend to trade or not be correlated to any of those assets. And that's an area where an example might be a place that plays with currencies or buys and sells currencies. Really has nothing to do with the fundamentals of an individual stock. Or it could be someone that buys the premium or spread between a takeover target in stocks. That really has nothing to do whether the GDP is going to be 4% or the GDP is going to be 1%. It's going to be, does that company buy that company? And so that tends to have a diversifying cat. So on the downside, that looks interesting, and we've have actually increased our exposure to that in our accounts. On the upside, I wouldn't use the word value or growth. I would use the word cyclical. I think like semis, which are historically considered cyclical, would probably are going to do very well coming out of this bottom. Another growth area which is more on the value side, would be industrials. Your 3Ms of the world, or sorry, I'm not supposed to be mentioning individual stocks, but
you said plural, like
world,
that.
Right?
It's not that. It is like
okay,
that.
But just so industrials by name that are tied to the railroads, truckers, that type of thing, those tend to do well. Another area that's very struggling mightily right now is the home building industry. Mainly because the mortgage rate's gone up over 6%. I mean, just think about that. 9 months ago, it was like 2 or 3%, and now it's 6+ and going higher. At some point, that area is going to look very appealing. We're not there yet, but at some point, that could be another place to look at. An area that I like a lot right now is the defense area, because if you think about it, you have the increased risk that's coming with the Ukraine Russian crisis, that we're shipping a lot of our storage of weapons and munitions is going to Ukraine that we're going to have to refill. So it has nothing to do with the economies. So that's a plus. And then you have the Navy risks with the Chinese Taiwan issue, that we have to keep up a strong Navy in the Pacific side. So actually you're getting almost like a two supports for defense stocks. So I think that's another area that looks very promising right now.
Okay. And I would imagine that, like, for government spending too, I mean, that happens in good economies or bad.
Yeah, that's true.
Yeah. All right. That would make some sense. Yeah, that would make some sense. I would imagine that patience is incredible virtue needed to be a good investor.
So, think about what your financial objective is, your plan in place, and then, go with that. That's what the advisor, that's what the money managers are there for, to make sure that you have diversification, to make sure you have stocks, to make sure that you have bonds, that you make sure you have the right cash levels. And if you need cash, we can provide the cash to you. So that's what I mean. So just don't panic. Don't pull your money out of the market. It's not a pleasant sight right now. Volatility is high, but it can't rain 100% of the time.
That's
unless
right.
You're in Myrtle Beach during a hurricane.
Yeah, but again, it passes, right?
Yeah,
through the eye of the storm, it might be good.
Yeah, the golf courses will be nice and green afterward.
That's right. That's right. And my game will probably be still as bad.
But you can stick the golf ball then, because you can hit it then.
Well, provided that, it plugs in the rough over there. That's what it does. Yeah. What are the analogies that when I hear you speak, I think in terms of analogies. It's almost like, hey, if I'm driving to Florida and I catch a red light, that doesn't mean all of a sudden I get out and get on a bicycle.
Right.
It's like, look, hey, it's going to be better that I'm in a vehicle than I am on a bicycle, right? So, hey, sell out and I'll put in cash, and I'm going to trade my bike in when the red light turns green. It doesn't tend to work that way. It's like, hey, on average, if I do this and do things right, be tax efficient, take advantage of tax loss harvesting, like you were saying. Also, when things are down, it's good for Roth conversions, all those types of things as well. But trying to foresee 2, 3, 5 years in advance on all the expenses that you need and where the different income streams come from, it really helps people put it in perspective. Or at least, guess what, listeners? That's what I hope so.
No, I 100% agree with that. I would say the biggest mistakes I see in the management side, or whether they're retail or professional, is the overconfidence where they think they know better than Mr. Market, and the overreaction where they sell out the bottom or they buy at the top. And that's what you have to have a consistent, disciplined process in place. And that involves your investment horizon and your asset allocation are the keys.
Yeah. Do you with the SMA manager, I'm going back, and this is a little bit technical, but when I go back to the separately managed account where you have the individual stocks in the account, is it easier as a money manager to manage that than it is a mutual fund? Because like you have inflows and outflows of money in a mutual fund, whereas is there any difference in the management of it?
The SMA has a little more liquidity, or there's a little more hands-on because it's more individually structured. So in that way, I like that a little better than the mutual fund, because the mutual fund is basically a great big conglomerate of stuff put together, and it sort of moves in the direction where your SMA is more tailored to that specific needs of that customer. Let's say your customer decides, after the hurricane, they want to build a house in Myrtle Beach, because they can, a mutual fund, you just sell the asset and who knows what the gains and losses are. But in an SMA, we work with the advisor and client to minimize, to raise the cash flow of the person, but it also minimizes the taxes, where that doesn't happen in mutual fund land.
Okay, good point. You can selectively decide on a lot of times what your capital gains could be.
Right. And I can selectively decide what stocks to buy and sell, where in a mutual fund, it's just, everything's sold. I need to raise X, so all gets sold at certain, the whole, instead of individual type side.
Okay. All right. Makes sense. As far as a money manager is concerned, what do you guys have to do to make sure you're investing money properly? What processes and people do you have in place to really methodically go through and do what you do? Can you give us a little bit of an idea of maybe it's a little bit of insight?
It sort of ties to what I've said, to what an individual analyst needs, an individual person needs to stay with their disciplined, repeatable process. And what we usually start with on the fundamental side, where that means you look at the products of the company. Are there products, is there pricing power in the companies? And sometimes that involves industry research, and sometimes it involves talking to the individual company or the managers of that company. We look at the balance sheets, the income statements. We do forecasted what their earnings are going to be. And probably the biggest thing is talking to management and whether they have a good shoulder on a good head on their shoulder, not shoulder on their head, a good head on their shoulder. What's their cash flow process? What's their capital allocation process? How do they invest their money? Because if we're going to give them money in buying their stock, I want to know what they're going to do with it. And that's probably one of the most important things. So, we look at that. Then we have to take that analysis on individual companies, and then we compare it to other companies in the same industry, and then other companies outside the industry. So we might sit there and say, wow, this is a great railroad company, and we like the fundamentals, but guess what? We like the semiconductor company better. And so we buy the semiconductor, or it might be vice versa. And so it just depends on what we look. We tend to try to look at risk-adjusted returns, because you can always buy something that can be up 50%, 100%. But the problem with that type of stock is it can also be down 50% or 100%. So we try to put a governor on that.
Well, how do you do that? Like, let's say what determines, okay, it's easy to determine, if a company's not making any money, maybe it's worth zero, right?
Well, how we sort of do that is we do upside scenarios on earnings and cash flows, and then downside scenarios on earnings and cash flow. So that gives you the earnings income side of the story. And then we look at historical valuations and give you upside scenarios on valuations and downside scenarios. So that gives you the multiples. So then you compare the multiples and the earnings, and that's where you get the target price or the expected target price. So usually we try to come up with a high side target price and a downside. High side target price is, wow, that they hit the ball out of the ballpark. Earnings are up, new product cycle. The other side of it is, what happens? Like, I can remember one of the best companies in the world was Motorola, and they used to have that little phone called the Razor that I don't know, that used to be the number one selling phone.
Oh, yeah, I remember that.
So it was thing. Like the number one selling. It's the flip phone.
Yeah,
probably.
Yeah.
Hopefully your audience knows what a flip phone is. The young my kids don't know what a flip phone is, but
we had the Nokia brick, that little brick. That thing.
But the Razor was the hottest selling phone on the market, and then it died and went away. So you got to be careful of that kind of stuff.
Yeah, I guess that would be challenging because you could end up with a Motorola, or you could end up with a BlackBerry.
That's another one. Or you look at it, and when Jobs came out and said, it started with the is it the iPod? Yeah, the iPod was the music thing. It started with
1,000 songs in your pocket.
Right. It went to that, and then went to the iPhone, and the iWatch and all, and that's just another one way back when I can remember was when Microsoft paired up with the largest producer of PCs in the world, which was IBM. And Microsoft said, "Oh, we'll be your operating system." No one, but which one of those would you'd want to? Now we know which one you wanted to bet on. You wanted to go with Microsoft, but that's another one where
and there was a wonderful documentary, and I don't know if it was reenacted or what, but it talked about that. The person who would play the IBM, we don't care about the software. No one cares about software, right? God,
now that's. I mean, one of the things I like to look at is when managements are wrong. Is there any penalty? Sometimes I get frustrated that corporations don't. There should be some penalty, like for example, Philip Morris went and bought Blue, which was the vapor cig, and they paid like $10 billion for it, and now it's worth practically zero. So I always want to go back and say, was there any reassessment of how you decided to spend that money? Because maybe we need change. They needed to change that process.
Right. Okay, that's good. And so, I guess, do more often than not you see penalties involved, or what?
No, unfortunately, you don't. When you see that, that's when you buy that company, because that means their asset allocation is stellar, and that's where, because ultimately they're putting money in projects that are growing and making money instead of putting projects that are historical. They're the elephant because they're probably big, but they're slow, and they're I hate to use the word dying off, but they're not a growing project. Let's put it that way.
Okay, but let's see, why would a company not do that? I mean, that not allocate it like that. What would be some of the reasons why a company would do that?
Well, a lot of it could be, quite honestly, I actually think sometimes when they sit down and have these asset allocation meetings, I think the one with the largest voice sometimes wins. I'm not going to say that, but another might be their largest or biggest product. And so for them to change streams would basically implement that they have an issue with that. So like, Motorola, their biggest product was the Razor, but to come out with something to cannibalize it.
Yes, that's tough.
That's
tough. It's like, hey, are you have the guts and the confidence to be able to pivot and say, hey, listen, the future is not where it's been, and change. Let's say Blockbuster Video or
right.
The Razor.
Well, and it's like Blockbuster Video was a cash cow. It was throwing cash out, and so the question is, to change that, you'd have to go lose money, and your current shareholders probably were used to you being a high yield cash cow, and they that's why usually you see a startup take over those newer industries.
That's right,
because it's just so much. But usually what happens sometimes, the good bigger companies, I hate to say this, then buy those companies where they still can. And so they get that they don't take the risk of the startup part of it, but they get the growth part of it.
Yeah, it makes sense. Like Xerox or Polaroid, with the stuff like things like that,
Right.
as well. I just love those kind of biographies and things like that. That's just cool stuff.
Well, people don't realize that Xerox actually invented the mouse.
Yes, the mouse network, and there was a third one.
I don't know that one, but the funny thing is Xerox has been an awful stock for. If you would have said who invented the mouse, who invented these, then you would say, oh, that's got to be and they just play.
And what they did was a quick story, and I know we got to wrap up, but again, another documentary I watched. They put the brightest minds in the 70s together, and they came up with the mouse. And I say, like a Windows operating screen where the mouse would go around the screen, a network, and there was the third one, and I don't remember what the third one was. And they didn't do anything with it. It was gone. It was like
the book study where they were book smart, but not, so.
Right. But again, that's what when you're big and heavy and fly too close to the sun, as they say. So
your wings melt.
That's right. Gosh, I love that stuff. So, well, John, it's been a pleasure chatting.
I've had fun. So
yeah. No, I've had a blast, and so thank you for sharing with you your insights and knowledge about current events, past events, and potentially future events. And so, thank you for joining.
Hey, one other positive I should just mention outright is the elections are coming up, and historically, if you have a divided Congress, markets tend to do well. So that's another reason why not to get too negative on this market. So
perfect. Thank you very much, John. I appreciate it.
Leave it to John to find something positive about politics. I'm telling you, that's fantastic. I believe, Jeremy, you might have been looking for the laser printer. Xerox invented the laser printer, so that might have been the case. Maybe number three. Maybe.
I want to say it's something besides the laser printer.
All right.
In that meeting, there was I can't remember the name of it. There was some name of the building, and there was like some think tank. And if I find it, I'm gonna have it put in the show notes.
There you go. Okay. There you go. And all that talk about the razor flip phone and all that stuff, I'm still waiting for Betamax to really hit big. Okay. Maybe that's not going to happen. I'm not a very good investor in that fashion. So, Jeremy, if people are interested in reaching out to you or John specifically, since John is your guest in the show, how do they do that?
Well, they can contact my office, 843-970-1049. And the cool thing about it is that if they have a portfolio they're concerned about, we're more than happy to have John and his team look over that and give some guidance. So just have them reach out to our office and set up a phone appointment, and we'll take it from there.
Fantastic. Well, thank you for that. And of course, our last thank you goes to your listening audience. Thank you so much for tuning in and listening to the Retire Happy podcast with Jeremy Finger. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jeremy comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually helps others find the show. Again, thank you so much for listening today. For everyone at Riverbend Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Retire Happy podcast with certified financial planner Jeremy Finger. If you have any questions, please visit us at www.riverbendwealthmanagement.com or call us at 843-970-1043. And remember, click the subscribe button below to be notified when new episodes become available.
Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor doing business as Riverbend Wealth Management. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.